I'm Charlotte McLeod with investingnews.com, and here today with me is Edward Sterck, Director of Research at the World Platinum Investment Council. Thank you so much for being here. Great to have you once again.
Well, thank you, Charlotte. Thank you for the opportunity to chat.
Yeah, really good to be catching up with you. And of course, the occasion, as usual, is the WPIC's latest Platinum Quarterly Report. So one of the key takeaways this time around seems to be that the deficit forecast for 2024 has been revised upward to over 1 million ounces. So that is up quite a bit from the deficit forecast when we were talking in the previous quarter. So I thought maybe we could start by just briefly going over what's behind that upward revision.
No, thank you, Charlotte. So the increase in the deficit is 552,000 ounces, which takes us beyond that million ounce sort of line in the sand. The increase really consists of two components. So firstly, we've included a new line item in the quarterly for this Platinum Quarterly, and that is the inclusion of larger bar demand in China. So that's demand for physical platinum investment products of 500 grams and larger. And that's something that we talked about in the commentary last quarter, but wasn't included in our figures, but now is. So that's moved effectively from being below the line. Previously, it would have kind of been incorporated in our above ground stocks number, and now it's incorporated into the demand figure. And so it increases the scale of that deficit by 188,000 ounces. If we take that out as being effectively kind of not new demand, but it's just now being reported, then the difference in the deficit between this quarter and our last update is made up of an increase in investment demand in terms of ETF flows. So previously for the year, we were forecasting ETF outflows of 120,000 ounces. That forecast was predicated upon higher for longer interest rates and commodity ETFs, including platinum and non-yielding assets. They tend to underperform in high interest rate environments. But what we've actually seen since our last update was significant ETF inflows during the second quarter. They've been pared back a bit since then. But those ETF inflows, which totaled 444,000 ounces in Q2, were of such magnitude that the estimate for ETFs for the year as a whole has been increased from that 120,000 ounces outflow to an inflow of 150,000 ounces. And then the rest of the difference is mainly made up of some changes to industrial demand. And in effect, what's happened is a glass production facility that was included within our numbers last year, and we've recently discovered has actually been deferred until this year. And so some of that demand has been taken out of last year and be brought into this year. And that's about 127,000 ounces of the change. So overall, big increase in the deficit versus previous projections. But there's a lot of nuances to that increase.
Yeah, and we're going to get a little bit deeper into some of the points that you just mentioned here. One of the things that I definitely wanted to go into is if we look more closely at demand. So 13% year-on-year increase in Q2 for demand, I believe, and that includes a 130% jump in investment demand. So you started to mention that a little bit on the ETF side there. Can you speak a little bit more about what's behind that increase there?
So look, in terms of the investment decisions behind buying into the Platinum ETS, I can only really sort of speculate. And I think gold has been a factor. So the high gold prices, probably prompted a bit of profit taking and a rotation out of gold into, something that's got certain similarities in terms of its fundamentals as an asset class or an investment product. And that decision's probably been accentuated by a lot of the things that we at the World Platinum Investment Council have been talking about with regards to platinum for some time, which is, the attractive underlying fundamentals. We're in our second year of consecutive material market deficits. Those deficits are being satisfied at present with above ground stocks, which are being depleted rapidly. And going forwards and looking beyond our Platinum Quarterly projections, which only go 1 year forward into the future, our longer term forecasts are for those deficits to continue for a number of years to come. So, from a supply demand or underlying fundamental perspective, at some point those deficits are likely to be reflected in the value setting mechanisms that determine where the platinum price sits. And for investors, that's quite an attractive opportunity.
Right. And strong interest on the ETF side. And if I'm understanding correctly, less so on the bar and coin side. So is that just because it's maybe easier for investors to invest by ETF versus the bars and coins, or any other thoughts on what's going on there?
Well, it's a bit of a kind of a question of dividing the market from an investor perspective into two parts. So the ETF investor demand is more institutionally led, and the bar and coin investor demand is more of a retail sort of picture. And I think on the retail side, the thing to bear in mind is that there are different reactions in different geographies. So we're seeing really strong ongoing demand growth in China, for example, for platinum investment products, and that's both the smaller bar and coin products and also those larger 500 gram and greater investment products I mentioned earlier. But in the US, on the other hand, there's actually underlying demand is still pretty good. But the US Mint this year appears to have elected to not produce Platinum Eagles, which are an important product for the US domestic market. That shortfall in domestic supply has been somewhat made up for by supply from other mints. So Britannia's, for example, from the Royal Mint, or Maple Leafs from the Royal Canadian Mint. And so other suppliers have stepped into the breach a bit, but you still can't really replace the domestic product in any particular market. So that's eroded demand there a little bit. In Japan as well, we've seen really high platinum prices in yen terms, and so that's prompting some disinvestment. Japan has a very advanced and sophisticated physical platinum investment market at the retail level. So investors there are active buyers when prices are lower and active sellers when prices are higher. So this year as a whole, because of those high platinum prices in yen terms, we're actually projecting platinum disinvestment. And that's what sort of drags down the overall figure together with the slightly weaker demand from the US.
Right. And you had mentioned a little bit about the impact of the higher gold price on demand for platinum. Of course, we have gold at record highs this year. So I wonder if there's anything more you can say about that. And is that impact of what's going on with gold, is it more significant in terms of the investment side or maybe in jewelry?
It's a bit of both, really. So I think we've kind of touched upon the investment side of things. There is just generally a view that platinum should play a bit of catch up with gold. On the jewelry side, certainly from a consumer perspective, there is an element of demand pull from consumers who are looking at gold jewelry products and going, I just can't afford that. So I'll look for the next most affordable thing, and platinum is the metal that kind of fills that gap at the moment. But the bigger impact is actually more on the fabricator and retailer side. So the high gold prices, together with higher interest rates, have effectively increased the cost of inventory management. So it's increased the cost of populating a retail store with the jewelry that you can see when you walk in off the street. And so jewelers are struggling with the increase in working capital requirements that's come along with that increase in funding costs. And one of the ways they can manage that is by reducing the amount of gold that they have in their retail outlets or in their fabrication facilities, and increasing the amount of lower cost, on a comparative basis, platinum products that they have in there. And so that helps them bring their overall working capital requirements down. And ultimately, the gold market is so big, it's kind of at the margins there, you're never really going to notice it. The platinum market is quite a lot smaller, and so the impact for platinum is that bit more meaningful.
Okay, so we've got the investment side there, but of course, platinum also has its very important industrial side for demand. So if we look over at the auto sector, I believe demand there is seen hitting a 7-year high in 2024, even though global vehicle production is expected to come in lower. So I was hoping you could talk a little bit about that and what's happening there.
Yeah, thank you, Charlotte. So, what we're seeing at the moment, and we have been sort of flagging this for a while, but actually I think it's the scale of the change that's probably catching even us by surprise to a degree. But in effect, what we're seeing is this ongoing consumer reluctance to adopt full battery electrification. And the market penetration growth rates for battery electric vehicles have simply stalled. I mean, they've basically plateaued. And, that's in effect, what's happened is the early adopters have adopted full battery electrification. They've done that with government subsidies and tax incentives that have now been scaled back. And those incentives have been scaled back because governments have taken the view that as production volumes increase, economies of scale will result in battery electric vehicles becoming more affordable. And we've certainly seen that, helped very much by China. But then trade barriers have been put up for protectionist reasons in different geographies that have eliminated some of those cost advantages of lower priced battery electric vehicles from China. And and yet at the same time, even though on the whole battery electric vehicles are becoming more affordable, consumers just don't want to buy them. And so the automakers who still have to meet their fleet-wide CO2 reduction targets are forced to pivot and in effect, focus on hybrid vehicles in order to hit those targets. And we're seeing that hybrid vehicles are now the fastest growing market segment in terms of market penetration rates, overtaking battery electric vehicles. Obviously, those hybrid vehicles still contain internal combustion engines. They still contain exhaust treatment systems that to treat the exhaust from those engines, and those exhaust treatment systems need PGMs. So it's feeding in very much to a higher for longer scenario in terms of automotive demand for PGMs. Platinum's obviously included within that. And actually, kind of going back to the investment demand, I should have mentioned this when we were talking about that. In terms of institutional investors, that's one of the biggest drivers of incremental new interest from institutional investors is the higher for longer automotive demand outlook. And this is coming from people who were overlooking the PGMs and platinum specifically because they had a view, being slightly flippant, that we're all going to be driving Teslas by 2030. And now they've kind of changed in their minds on that and think about what the impacts of that might be in terms of the underlying inputs into the automotive industry. And so that's helping from an investment perspective as well.
Right. So we're all kind of realizing at this point this is going to take a little bit longer than perhaps we thought it were to do that transition. Okay, so I think we've covered demand fairly well. I want to move over to supply as well and not forget about what's happening there. So it looks like supply increased in Q2, but if we look at 2024 or as a whole, supply is seen falling 1%. So what is the second half of the year looking like to you in terms of platinum supply?
So we've got a couple of things that are at play here. So firstly, in South Africa, there's a bit of planned maintenance, and that's dragging down numbers for this year a little bit. But you've also got a lot of the producers are making great efforts to effectively reduce costs. So we've seen 10,000 jobs come out of the South African platinum mining industry over the last 12 months. And that's reflecting efforts by the producers to cut costs. They're also working to cut capex and effectively trying to get their operations more cost efficient in the light of lower PGM prices. In particular, the fall in the prices of palladium and rhodium, which fell pretty dramatically last year. Ultimately, they're trying to make themselves more competitive in a lower for longer price environment. If we don't see platinum pick up the slack anytime soon, we're hoping that's not going to be the case, of course. But you've also got in Russia planned maintenance of a smelter there. That's been continually deferred as Nor Nickel, which is the Russian producer of PGMs, hasn't been able to find a domestic OEM to undertake the refurbishment of that smelter, or at least they haven't found a domestic OEM they had confidence in to undertake that refurbishment. So we are expecting a little bit of a normalization as those planned maintenance events come to a conclusion towards the end of this year and going into next year. But fundamentally, as we've seen in previous capex down cycles, it usually results in a long and gradual erosion of mine supply output. So through the course of the 2010s, we saw a negative CAGR of around 1.2% during the capex downturn, and it seems probable that something similar might happen in the future again, looking at the cut to expenditure the miners are making.
Okay, and then I think also important to cover, as you usually do, the status of above ground stocks right now and what that looks like.
Yeah, so obviously with our second year of material market deficits, above ground stocks are continuing to fill the gap and they are being depleted pretty rapidly. So on our estimates and our methodology for calculating above ground stocks, we expect to get down to only 4 months of demand by the end of this year, which is kind of below that 6-month rule of thumb in commodity markets where the market participants, particularly the end users, begin to get somewhat twitchy. The one kind of caveat I'd add to that is that we exclude certain things from above ground stocks on our methodology, so we don't include ETFs. The reason being, we see ETFs as generally continuing to accumulate material, so we see that as real demand, even though you can have periods where there are disposals. And we also don't include working inventories held by the automakers or by industrial market participants, because in our view, if you don't have those working inventories, you can't run those businesses. They're part of normal business management processes. Other market participants may include those inventories in their estimate of above ground stocks. So from a sentiment perspective, there's a bit of a grey area as to where you hit that pinch point.
Okay, really good points there. And of course, we also have to take a look at price. So, as we've been speaking for multiple quarters at this point, we have these positive supply demand fundamentals for platinum, and yet the price remains pretty range bound. But when we had talked last time, you mentioned maybe the second half of the year is when we start to finally see the tightness in the market that's building actually be reflected in price. So, how are you feeling now as we're actually moving into the second half of the year?
So since we last spoke, we've actually done a lot of work on that, and there will be a report coming out in due course. But to give you a kind of one of the early takeaways from the work we've been doing, we've built a full mathematical pricing model and looked at multiple variables that kind of feed into establishing value in the platinum price. And essentially what we've seen is up until about 2010, underlying supply and demand fundamentals were really the key drivers in terms of establishing the platinum price. And since then, other factors have become more important, mainly market factors. So that's things like the price of gold and the rand dollar exchange rate, and also things like sentiment drivers, principally reflected in futures positioning. So in effect, what's happened is, if you think about the last or the period since around 2010, we've seen the decline of light duty diesel ownership in Europe. That was accelerated by what's known as Dieselgate in 2015. And then we've seen the rise of battery electric vehicles. And from a sentiment perspective, those things have fed into just general market expectations that a significant portion of platinum's end demand is going to disappear over time. At the moment, automotive demand for platinum is about 40 to 45% of total demand in any given period, and it was back then as well. But I think that's the point, actually. Since Dieselgate, what we've seen is, yes, light duty diesel market share in Europe has continued to decline, but platinum has been substituted into gasoline vehicles all around the world instead. And we've also seen, in terms of battery electric vehicle market growth, that the growth has underperformed versus expectations. And as you mentioned towards the beginning of our chat, this year is expected to be the highest year for automotive demand for platinum in the last 7 years. So actually demand is really there. We just think that the market hasn't quite caught up with the real demand outlook from where we stand currently. But together with the decline in the prices of palladium and rhodium, which are putting more pressures on supply, these factors, higher for longer demand and supply challenges, we think are going to result in those underlying fundamentals returning to being the most important price setting mechanism going forwards. Whether it's going to be in the second half of this year, we're still hopeful, but it's quite hard to predict the timing of these things.
It is quite difficult for sure, but we'll look forward. I'll be curious to read the report when it's ready, and that'll probably be interesting to talk to as well. So I think we've covered the market fairly well at this point, but before I let you go, are there any final thoughts on platinum that you would leave investors with?
I think, since we last spoke, one of the key things that's occurred has been Shanghai Platinum Week. We touched earlier on China being the most important market for platinum, for PGMs in general, the biggest consumer globally. And Shanghai Platinum Week really was a fascinating event. We're one of the organizers of that. Just to highlight a couple of the statistics from that I think are quite salient to how important PGMs are within China. We had around 500 in-person delegates. We limited numbers a bit this year, but it was also broadcast live within China online in terms of live streaming. And the viewing numbers were quite extraordinary. So on the first day of the seminar, the actual presentations, we had 480,000 people watch the live streams. And there was about 300,000 the second day, probably a bit of overlap in those numbers. But that's an extraordinary number of people interested in platinum and the derivative industries that it goes into. So, it just shows how important and platinum is from a strategic perspective within China and also to many other countries around the world.
Okay, well, that sounds like a good place to wrap it up. So we'll leave it there for now. I'm sure we'll check in with you in another quarter, but thank you so much for coming on to go over what's happening in platinum.
Super. Thank you, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Edward Sterck with the World Platinum Investment Council. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.